In this lesson, you will look at the differences that occur in the bookkeeping systems of different types of businesses: sole proprietorships, partnerships, and corporations. Then you will explore the differences in bookkeeping systems in service companies, merchandising companies, and manufacturing companies. The knowledge you gained in Basic Bookkeeping Level 1 will help you understand these differences. In the Basic Bookkeeping Level 1 course, you looked at the bookkeeping system of a single-owner business. The business you studied was XY Consumer Products, which was owned by Jeff Smith, a single individual. This type of business is called a sole proprietorship, and Jeff Smith is called the proprietor. Proprietorships tend to be small retail businesses, or businesses where the owner provides most of the services offered to his clients, such as doctors or lawyers. From a bookkeeping point of view, a sole proprietorship and the sole proprietor himself are two distinct entities, meaning that when you prepare financial statements for the proprietorship, you should include only those accounts that relate to the business. For example, the assets of XY Consumer Products recorded on the balance sheet would include the building, inventory, etc. of the business only, and would not include Jeff Smith's personal assets, such as his house or his personal checking account. Another form of business ownership, which is very similar to a sole proprietorship, is a partnership. In a partnership, a number of owners join together to create one business in which they each own an agreed-upon percentage. Partnerships are very common in the business world, especially in the fields of accounting and law. Partners, who are the owners of the partnership, can combine their assets and knowledge capital to form a viable business to serve their clients in different segments of business. For example, an accountant who specializes in financial accounting may want to form a partnership with another accountant who specializes in auditing and another who specializes in tax. In this way, they can all share their knowledge to offer the best service to their clients. Most partnerships are small or medium-sized, but there are accounting and law firms with more than 500 partners. Just like a sole proprietorship, for bookkeeping purposes, you must be careful to keep the assets, liabilities, revenues, and expenses of the partnership separate from the personal assets of each partner. The third type of business is called a corporation. A corporation is a business owned by one or many individuals who are known as shareholders. Each shareholder owns at least one share of stock in the corporation. Each share entitles the shareholder to one vote in the strategic decisions of the company. Once a business has incorporated or becomes a corporation, the terms limited, incorporated, or corporation are usually added to the name of the business. When a business is incorporated, the liabilities of the company are limited. This means that the shareholders' responsibility for the debts of the company are limited to the amount they invested in the company. The shareholders of a corporation have ultimate control of the corporation. However, many shareholders do not exercise their control over the strategic decisions of the business. Shareholders instead elect a board of directors to act on their behalf and make the decisions necessary to ensure a profitable operation continues to exist. The main purpose of investing in a business is to earn a return on your money. For instance, if you had $1,000, you could invest this amount in a bank account and earn interest. If, however, you invest this money in a business, such as a corporation, you would earn a different type of return, called a dividend. A dividend is an amount of money paid out of the business to every shareholder. The amount of dividend paid may be a fixed rate, so the same amount is paid every year, or may vary depending on the earnings of the corporation in a given year. Similar to sole proprietorships and partnerships, a corporation is a separate entity from its shareholders. You studied the bookkeeping system of a sole proprietorship in detail in Basic Bookkeeping Level 1. Now you will consider some of the unique characteristics in the financial records and bookkeeping processes in partnerships and corporations. Bookkeeping for a partnership is similar to bookkeeping for a sole proprietorship in all ways except one. Recall that, with a sole proprietorship, you have a single capital account. In XY Consumer Products, you had an account called Jeff Smith Capital. The drawings account was also used to record any assets, including cash, that were withdrawn from the business by the owner, Jeff Smith. At the end of the year, you closed the drawings account to the capital account. You also closed the income summary account to the capital account at year end. By doing this, you updated the capital account to reflect the income earned in the business during the year and the money the owner had taken out of the company. You will follow the same process for partnerships, except that now you will have a separate capital account and a separate drawings account for each partner. Then, at the end of the year, you will close each partner's drawings account to his or her capital account, and then allocate each partner's share of the net income or loss in the business from the income summary account to his or her capital account. Finally, there is one slight terminology change you should notice with partnership bookkeeping. Recall that in the books for the sole proprietorship, you recorded the capital and drawings account in a section titled Owner's Equity. In a partnership, this section will be called Partner's Equity rather than Owner's Equity. In the task, you will practice recording bookkeeping entries for partnerships.